What's up, guys? Welcome back to DCA. Tonight, what we're going to do is talk about four-year market cycle theory. In our last video, we discussed lengthening market cycle theory, which, full disclosure, I do not believe four-year market cycle theory is correct. And tonight, I'm going to discuss the primary reasons why I think this theory is flawed as it's currently constructed. I am a proponent of lengthening market cycle theory, but for perhaps different reasons than you hear commonly discussed. So if you're interested in learning more about lengthening market cycle theory, you could check out that video. I'll leave a link in the description below. Four-year market cycle theory. This theory is constructed around the idea that there are Bitcoin halvings, okay? So the halving events occur approximately every 4 years, if you're unaware. And what these halving events essentially mean is every time there's a halving, the reward going to the miners is cut in half. So as the reward is cut in half, basically the miners supply the Bitcoin onto the market. So they are the suppliers of newly created Bitcoin onto the market. All right. So that is the reason that there exists this idea that there is a 4-year market cycle. Okay. So every 4 years, 2012, we have them marked here, 2012, 2016, 2020. The next will likely be right around 2024. Okay, so approximately every 4 years, you're going to see these halving events. And each time, the new supply of Bitcoin being created is cut in half. So in other words, the reward to the miners is cut in half. So we're going to look at this tonight and discuss why this won't necessarily create a 4-year market cycle going forward. In fact, I believe it will not create a 4-year cycle going forward. And I'm going to show you tonight why that is. So like we said, the 4-year market cycle revolves around this idea of the halving event. So, back in 2012, there was a halving event, 2016 halving event, 2020, and basically the reward going to the miners went as such. The original reward was 50 Bitcoin to your miners up until around 2012, the end of 2012. Then they got 25 Bitcoin for each block. Okay. So from here to here, they got 25 Bitcoin for each block. Then they got 12 and a half and so on and so forth. So now we're sitting at 6.25 Bitcoin per block reward to the miners. Okay. So the miners are rewarded this Bitcoin for maintaining the network. The reason that this creates, in theory, a 4-year market cycle is because in the past, so in our market cycles, let's look at our 2013 and, we're on a 6-month chart actually here. Let's just bring it down like this, something that's a bit more familiar to people. So at this time, the supply hitting the exchanges, where is it coming from? Well, at this time, primarily your supply is coming from the miners. Okay. So the miners are the one creating the new Bitcoin, and they are the one putting the Bitcoin onto exchanges. Now, you have to think about it like this. If you're a miner and you have these significant energy costs to run your operation, and Bitcoin, so here's the halving event. The price of Bitcoin is $13 at this time. Well, do you want to put your Bitcoin that was, recently as high as $30 onto the market when you think that if you hold on to that Bitcoin that you have, it will go up in price? Likely not. So what happens is there gradually becomes a supply shortage. Okay. Even if demand stays static, if demand does not change, supply decreases because the miners now, before, they were getting 50 Bitcoin per block. Now you're getting 25. So the costs of running your operation have not changed. They are static. Yet the reward you were getting was just cut in half. So the miners will then hold on to their Bitcoin here, and that will cause a supply shock, as it's termed. And what that does is raises the price of Bitcoin, because now if you're interested in purchasing Bitcoin, well, there's no supply. So, it's like, think about anything. Think about cars. If there's no If there's no cars, there's a car shortage like we just saw with COVID. Well, if you wanted a new Corvette, for instance, the new Corvette was, has an MSRP of $70,000, but you can't find the new Corvette for $70,000. It probably is going to cost you $100,000 to $120,000 because the supply is falling short of the demand, which causes a rise in price. Okay, so we can look at that one other way quickly. So this is a supply and demand curve, all right? And what this basically shows is here's a quantity of any good and here's a price of any good. Okay, so if you just wanted to apply numbers here, let's call this 60,000 and we can call this right here 45,000, and down here we'll just say 30,000. Okay, so think of it just a standard graph, and down here, whatever numbers you want. Okay, so we'll just call this 1,000 and we can call this 500, and then down here 100. Okay. And what this basically shows you is, well, as a consumer, how many people were demanding Bitcoin at 60,000? Okay, so we'll just call it, just to be clear, 60,000. How many people were demanding what quantity? Well, not many. Not many people wanted Bitcoin above 60,000. That's why we haven't been able to hold that $60,000 price level yet. And here's your supply curve. Well, so at 60,000, this is how many people demanded Bitcoin, but the supply, the miners were willing to sell all of their Bitcoin at that price. Okay. So you have basically a supply demand disequilibrium. The way that the price will find its equilibrium, which is what we've done, or what a market is constantly doing, it will find its equilibrium right here. Okay. So that's what the E stands for. So this is the price where the demand is meeting the level of supply. Like we said, as you hit the halving event, what happens? Well, let's just assume that as a consumer of Bitcoin, we don't change our demand. Our demand is sort of fixed because the supply is decreased. Now the miners, they still have to pay for running their operation. Okay. So what happens is, because the supply is decreased, this line shifts over to the left, okay? So we get a leftward shift. So what you can see happens is the miners are now not willing to just put their Bitcoin that they do get out on the market because it's a more scarce resource now. And they need to pay for, running their operation. So in order to pay for their operation, they're going to hold on to their Bitcoin at a similar price. So whereas before, at a price of around 40,000 or whatever, that, this equilibrium one that we have right here, they're no longer willing to supply around 500 Bitcoin at that level. Now they're only willing to supply 400 Bitcoin. So now at that same price, if we just go over here, if we bring this price over, let's just say that this was 40K. At that same price, whereas they were willing to supply 500 before, now they're only willing to supply 300, okay? And because of this difference now, you can see we're no longer in equilibrium, right? So what happens is they won't supply 500 Bitcoin, which is where the demand is at this price. So what happens? They will supply 400, which will meet the demand curve over here at this level at around 45K. Okay. So I know these lines aren't perfect, but the point remains, the concept remains. And this is how markets work in general. If the supply is falling short of the demand, this supply curve shifted to the left and the price will move upwards due to that demand, remaining constant and the supply decreasing. So decreasing supply equals increased price if demand remains the same, okay? And in this case, we can say that demand relatively remains stable as we've seen, but the supply decreases, all right? So that is what has been causing the, relative stability of these market cycles thus far, giving us the appearance of 4-year market cycles. However, going forward into the future, or even right now, let's say, so as we get this situation where 6.25 BTC per block is where we're at now. Okay. And of all of the Bitcoin, if you're unfamiliar, there will be 21 million Bitcoin. All right. 21 million. Well, currently we have about somewhere, I don't know the exact number at the moment, but it's somewhere around 18 to 19 million. I think we're in the high 18 millions at the moment. Okay. As time goes on, we are approaching the entire supply of the Bitcoin market. What this means is that the miners are no longer generating the majority of the Bitcoin that goes onto the exchanges every day. Okay. Because the vast majority of Bitcoin has already been mined. Now, they will continue to mine the remaining 2 million or whatever it is Bitcoin over the next 120 years or so. But the fact remains that most of the Bitcoin that is to be mined is already out there. So the miners can no longer meet demand simply by mining Bitcoin. That demand now currently comes primarily from long-term holders, shorter-term holders, and exchanges. So those three sources have become the primary suppliers of Bitcoin being sold on exchanges every day. And in the past, that was not the case. The miners were the ones supplying the majority of the newly created Bitcoin, or Bitcoin going out to meet demand. You could think of it as, it's a twofold prospect. Number one, the miners' relative importance on the new supply of Bitcoin is decreasing because their reward is decreasing and the majority of Bitcoin have already been mined. Number two, the market is becoming significantly more complex as time goes on. And, there's new players in the game now. And on top of that, the exchanges are by far the largest contributor to the supply of Bitcoin hitting the market at any given time, followed by long-term holders and, prospectors. This halving event is becoming relatively less important as time goes on. In fact, given that we've already mined, the majority of the Bitcoin, a vast majority of the Bitcoin that will ever be mined, the miners' current effect is relatively negligible. Now, that's not to say they don't still make, there isn't still extravagant profit to be made for the miners themselves. It simply means they aren't the ones determining the market for Bitcoin anymore. And in these prior cycles that you saw back here in, 2009 to 2013, and then 2013 up to 2017, they were certainly large contributors to the market cycle. They still do impact the market, but to a significantly less degree. And for that reason, it's simply just saying that we're going to continue to have 4-year market cycles is outright ignoring that fact. The bottom line is this, I feel like whenever you're on YouTube, for instance, it can be greatly misconstrued, everything that you say. When I say that I do not believe 4-year cycles are what's happening, that doesn't mean that any given cycle can't be 4 years. This cycle could be 4 years, but that has nothing to do with, what we're saying here. A 4-year cycle could incidentally be created by macroeconomic level events that are exogenous to the Bitcoin or the cryptocurrency asset class, influencing investors who would otherwise be investing in the cryptocurrency asset class. And this is what I said was, the primary thing with lengthening cycle theory. This cycle could easily be 4 years. Okay. So, if we just measure let's just go from top to top. That's about 4 years, 204 weeks. Okay. So, 52 times 4 is 208. We've been from peak to peak, we've been about 204 weeks. So, that's about 4 years. But that doesn't mean that this top was created because of 4-year market cycle theory. All right. It could have some effect on it because, as we said, over time, the effect that the miners have on the network will decrease. and is continuing to decrease. But as each new halving event occurs, that decreasing effect that they have becomes magnified. But what this means is that even if this cycle happens to be 4 years, that could be entirely incidental. And what I mean by that is, these outside events such as COVID, we just had a record number of COVID cases occur. I believe yesterday was the highest number of COVID cases in one day ever. You have Evergrande, a real estate crisis in China. You have the Fed talking about perhaps raising interest rates in 2022. These things are going to affect the cryptocurrency asset class, and that has nothing to do with the miners or 4-year cycle theory or lengthening cycle theory. So while I believe in lengthening cycle theory, any given individual cycle can still be 4 years or 2 years or 3 years or 6 years. So, the idea that this cycle must lengthen because we believe in lengthening cycle theory is simply not true, because outside events can influence any individual cycle in isolation. Okay. And that can cause a individual cycle to be 4 years, but it doesn't invalidate lengthening market cycle theory. Okay. So I know we've talked a lot about, some economic theory tonight and as it applies to Bitcoin and the cryptocurrency asset class. Hope I'm explaining this somewhat clear. I know, people sort of, their eyes roll to the back of their heads when you start showing them things like this, but I think it's important because you have a lot of people that seem credible that are saying, this has to happen like this has to happen like this, and this has to happen like that. But they're ignoring macro level economic events, and they're ignoring things like the relative decreased impact that, for instance, the miners have on the supply of Bitcoin, which decreases the chance that they cause a 4-year market cycle to repeat every 4 years. Okay. So that's it for this one, guys. If you guys like this type of content, hit like and subscribe. And until next time, as usual, see you.